Good morning, Jags. This is Fahad. Today is Wednesday, March 3rd. Let's get started. An update on a stock that is of very much of interest among a lot of Jag clients, particularly pro clients. We have been fielding a lot of questions on this one. This is called Pulmonex, symbol LUMN, Pulmonex. Now, many of the Jag clients will know that Jay presented a fantastic bull case about this stock on homepage. I believe this was back in November. I'm trying to pull that on my screen over here. So hold on 1 second. Here we
Yeah, it
go.
was November.
Yeah, so November 25th, right over here, in which we talked about commercial traction. This was presented on homepage, and it's if you haven't read it, read it. If you haven't read it, you should. Lots of interesting stuff here. This is a very, very interesting medtech company and a very high growth company. However, there was a question that was asked before earnings that came out, which was this morning or last night rather. A client was asking a question in the chat room: should we take a position into this one going into earnings? And my concern was, as I expressed, that this company's products require a 3-night hospital stay, and it usually serves the severe, patients with severe emphysema and other conditions. So this is not something that is out the door kind of treatment. It usually requires, half a week of a stay in the hospital. And we were going through a period in November, December, and January where things got really rocky with a lot of shutdowns taking place everywhere. Management was pretty straightforward about that. So the last time when they reported earnings, which was in November, they did tell us that they're going to see some small sequential deceleration from Q3 to Q4, primarily because there's going to be shutdowns coming. So as a result, that was my concern, and I said it's not a good idea to take a position going into earning. But now earnings are out, and I have some really important color on this one. And now I think a brand new recovery in this stock from here could begin. First of all, the consensus going into this earnings was only $8.2 million, and which was a step down from $10 million from the prior quarter for revenues. Company did $9.8 million. So despite the lockdowns, despite all of that, they actually ended up doing pretty good. But then, and if you look at the chart in pre-market, there's not a lot of volume, but it's guided higher. It closed at $58.05, and the bid in pre-market is $61 per share. So this thing is going to gap higher. And where is that $61 where the bid is in pre-market? Technically, it is right where this major VOP resistance comes in. It's going to clear that in pre-market and likely to make a run back towards $70 per share. I don't know if it will happen today, but the trajectory is now to the upside. So what did we learn from this quarter? It's the qualitative commentary that matters, right? And here is a comment that comes directly from the CEO, right here where the yellow highlighted is. What happened was we sort of bottomed out, and it carried into February, basically the first couple of weeks of February. So that's kind of the shape of the curve. It was a little less V-shaped and a little more U-shaped. And we have some very encouraging and more recent information as it relates to pulling out of that. And it looks extraordinarily familiar to the last 2 times we got hit with waves here in the United States. Going along with that thought, an analyst named Robert Adam Hopkins in the earnings call, the Bank of America analyst, asked the question: it kind of feels like you're almost back to levels that would suggest, as long as you keep on the run rate of late February, early March, that's all you need to do to get to the guidance for the year. And the CEO said, right. In February, the number of active centers in February, the number of active centers in February, or the percentage, was 33%. So we are just reigniting those centers. So we will still have, if the normal is 70%, then we would expect roughly a doubling as we go forward from here of those centers being active to get sort of up into that range. Now, those are commentary that's telling us that basically they hit the absolute bottom in the middle of February. They saw a ramp higher in the second half of February, and that momentum has so far continued in the month of March. Specifically, I will give you more color on this one. Procedures volume in the second half of February versus the first half of February increased by 30%, while the revenues increased by 80% as accounts put valves on their shelves in anticipation for procedure volumes to continue to increase. Pulmonex also noted that procedure volumes in the first half of March were expected to increase by 34% relative to the second half of February. And all of these factors indicate that while account activity has remained subdued year to date, procedure volumes are rapidly picking up and accounts are preparing for further volume. Bank of America, I quote over here, one particular comment that comes out, they pointed out that in this particular case, quote, notably, on the business development front, Lung added 55 accounts and 13 representatives in the United States in 2020. And going forward, they're guiding 50 plus account adds and 10 representatives in year 2021. It is clear that Pulmonex is having success developing this market and growing the infrastructure for when COVID headwinds lift in the coming months, and is well positioned to see revenue acceleration once these pressures wane. Basically, we are now beginning in Pulmonex in accelerating ramp in revenues. How high could it get? Based on the projection that's out there on the street, you're going to see revenues go from 33 million last year to doubling to over 50 million this year, then doubling again and possibly accelerating to 75% year-over-year growth in 2022, and then maintaining that rate for at least until all the way to 2024. Accelerating revenue growth generally leads to market valuation expansion, and the stock should react with a positive breakout on this. Jay, you have any thoughts on this?
Yeah, I was looking at Stifel's post-earnings note as well as B of A's that you had highlighted. Just a couple of other mentions. I know B of A did call out that their lockup agreement expires later this month on March 29th. And then looking ahead, or looking out a couple years, if you go to the conference call, management talked about investing in new technologies to sort of broaden the patient population. And one of those areas, or one of the things that they're developing, is something called AeriSeal, which they describe as a polymeric foam that is designed to be delivered via a bronchoscope to a targeted region of the lung to treat selected emphysema patients with positive collateral ventilation who are currently not eligible for Zephyr valves. They went on to say that they did receive designation of AeriSeal as a breakthrough device by the FDA in December, but it is still a couple years away from potential commercialization. So, definitely something to look at in the long run.
Yeah, and this is how it usually goes. They're going to keep branching out with new products and keep expanding their moat. This key product will be another lever going forward in the long run. So interesting update there as well. So I expect the stock to break out, but a lot of it depends on the market conditions too. But overall, I expect the stock to break out, and I think this should easily get back to 70 plus over time with improving trends. Separately, I want to quickly just highlight some earnings reviews over here, going to keep a very high level. We have been very, very bullish on travel and leisure sector. So what I did last night was just to kind of complete my research piece on this and get my head around everything that I'm seeing. I pulled the earnings transcript from every lodging company that has reported so far. That's Marriott, that's Hilton, the Choice Hotel, and Hyatt, the 4 biggest operators in the United States. And skim through all the management commentary to see what are they all saying, if there is a common denominator among all of these earnings transcript. And here's what I found out. Let's talk about Marriott. You can see this stock had a fabulous reaction to very strong earnings and on rising volume, clearly indication that this stock is under accumulation. Here's what stood out for me. Marriott noted several early signs, I quote, several early signs of recovery. Number one, they noted transient booking pace and direct booking site visits are improving sharply. They also said that their January bookings were 11% higher. January of 2021 we're talking about, so this was a fourth quarter that they were reporting. But they said that the January 2021 bookings were 11% higher than January 2020. And they also said that volumes over the last 45 days for summer travel has increased somewhere between 25 to 30% based on booking trends. So for the upcoming summer. So they're going from negative growth to January being 11% year over year. And then the bookings that they're seeing for summer travel is generally resulting 25 to 30% sequential improvement. That's what Marriott said. And then let's go to Hilton real quick. You can see same here too. This company reported earnings. Stock responded very nicely, hitting new 52-week high, irrespective of what was happening in the market. They said, I quote over here, most large corporate accounts are agreeing to extend 2020 rates to 2021, meaning that the bookings that they saw last year, which were then put off for corporate travel, they are not being canceled. They're simply being delayed, which is slight positive. And they said that a sequential uptick in corporate demand in Q4 was seen of last year versus Q3. And similar to Marriott, Hilton said that their January lead volumes were up 35% January versus December of last year. Overall, they see that the trend by the time summer is here could rise as much as 50% above normal. Now, Hilton, this is Hyatt chart, sorry, this is the Hilton chart. Hilton benefits from the corporate travel far more than Marriott. So they are, in this particular case, not only saying recreational bookings are strong, but also the corporate booking coming back sharply. Then Choice Hotels, CHH. Just one of the stocks that has performed far better, lower price hotels, as you know. This has been consolidating for about 3 months. What did they say? They said, I quote, looking forward, despite short visibility, we are noticing 31-day bookings have been improving consistently since November. That's exactly what the management said in their earnings report. They do expect that the RevPar growth in the first quarter of 2021 will actually come in positive rather than last year. And then the last one is Hyatt. And you can see same here too, when the company reported earnings, the stock nicely moves high. What did they say? Well, this one, by the way, is a lot of these properties in the recreational areas, lodging properties in Hawaii and Key West and Caribbeans and all of that. I've been to many Hyatt properties, one of my favorite hotels. This is what the management said in the earnings call. I quote, a meaningful acceleration in group bookings in Q4, rising by 20%. And then they went on to say that association corporate booking activity is picking up for bookings in late 2021 and late 2022, and early 2022. They also said that cancellations are declining. First, originally they were seeing far more sharp decline in cancellation, but now cancellation, the pace of cancellation is declining sharply. And similarly to all the other hotels, they said January lead volumes rose by 50% over December, with 60% of that related to 2021 travel. There you go. 50% increase in volume sequentially from December to January, with 60% of those new bookings that are coming in are all related to summer travel. Folks, I'm telling you, all of these travel stocks are going higher, and they're going to continue to move higher because that's the reopening theme play that we have in front of us. Ignoring these trends and not making plays on those, not making money on those as they recover, there could be big boost to the portfolio. All right, that's it from me. Let's go to Jay.
Morning, everyone. So yeah, just a quick mention today. So every night on my watch list, I put in all the tickers that have reported after the close, and then kind of get ready for the next day with the companies that are going to be reporting before the open. And sometimes this is where I find these under the radar companies that not many people are paying attention to. One of the companies that I came across again last night was Transmedics Group, ticker is Tmdx. Now, unfortunately, the last time I covered this name was actually in January of 2020, and for the entire year, stock didn't do anything. But now 2021 happened, and this thing's up, I think, nearly 100%. So I definitely missed it. But I want to go back and I want to take a look at this company again. It's a med tech company that offers the Organ Care System, or OCS, which is essentially a portable organ perfusion optimization and monitoring system. Essentially, it's taking, or it's replacing the typical approach to donor organs, where you put it in a plastic bag on top of ice and then transport it in a cooler. So it's kind of changing all of that. So they reported earnings after the close yesterday. So I'm going to take a look at that more closely. Looking at JP Morgan's post earnings note, one of the things that they do mention regarding the pipeline is they have an OCS heart DBD panel, which is scheduled for April 6th, with a potential positive decision leading to an approval 2 to 3 months after that, with revenues starting in Q3 of 2021. So that caught my attention as well. And so I'll probably have a homepage write-up. We'll go over the call, we'll go over all the notes, and then create a homepage article for everyone. It might be today or it might be tomorrow. We'll just kind of see how it goes. But yeah, expect the homepage write-up on this stock at some point this week.
Sounds good. Looking forward to an interesting niche market for them. And I'm assuming they're category leaders in transporting organs safely and handling them. So I wonder, though, this is not a new industry per se, right? I mean, organ transportation has been around for a long time. So what has sparked the interest all of a sudden, though, in this stock with such a dramatic rise in recently? So it's more about what caused it and how it may continue to change for the company, rather than, because I don't know what they're doing differently, basically, on the transportation side than before.
Yeah,
okay.
I'll cover all that, yeah.
Sounds great. Let's go to Chronicle.
Morning. Just a brief update today on Green Tree Hospitality, ticker GHG. I first laid out the bull case for this company in conversations back on August 31st. Personally, I haven't been in the stock, but it's been on my watch list lately because I suspect there's been a lot of accumulation going on in the past 6 to 7 months, with the stock being in a very tight range. And I think the upcoming earnings is going to be an important catalyst, which could finally mark the end of all that accumulation. So just to quickly refresh, this is a leading operator of franchise hotels across China, with 2/3 of their portfolio situated outside of the Tier 1 and Tier 2 cities. So they're targeting mostly domestic tourism and business travel, since it's the locals who tend to really venture out to those parts. And price-wise, we're talking mostly in the mid-range. Like they're basically catering to the growing middle class. And the bull case here is twofold. First of all, the obvious tailwind is the ongoing domestic travel recovery within China, which has helped the company to report really impressive sequential growth in revenue and RevPar in the 20 to 30% range, respectively. In fact, company's occupancy already reached a pre-pandemic level in November, and the room rate has recovered to 95%, according to management. And it looks like the lower tier city locations have been recovering faster. But the other bull case, which I believe is not being talked about enough, is that the company continues to build out its portfolio and is gradually expanding into upscale. Like a couple years ago in 2019, high-end use used to be low single digits percentage of the portfolio. Sorry about that. But now it's closer to 10%, from 128 to 218 properties, representing 28% of all of their new openings. And according to filings, this segment has significantly higher profitability, which has helped their EBITDA margin increase to just under 50% for the latest quarter, while the overall gross margin is now at 59.5% versus the pandemic trough of 43%. Valuation-wise, we're looking at about 6.5 times forward sales, 17 times PE, and 1.2 times PEG. So it's not an expensive stock, and from a risk management perspective, I don't really expect much downside to the stock if things go wrong here. So I really like the risk reward here, and looking at the chart, the accumulation that's going on here reminds me of the chart of Enlight, ticker LASR, right before it exploded last year. And I think this has a lot of the earmarks of that. One last thing, the company is currently expected to report between late March and early April.
Sounds good. And this is once again a reopening theme stock. Also goes into the lodging sector. This one is specifically focused in China. So it's going to it's going to bounce off and benefit from the same rising trend. So I like it. And you're right, chart has been consolidating for such a long time, but maybe this is the change in character that is beginning. Let's see if this will start to clear through all of this, call it about $14 per share on rising volume. And if it does, it's a confirmation, then I could see this thing quickly run to $20 per share. Interesting stuff. Folks, I want to come back. I want to discuss DraftKings here real quick because as you all saw that there's news this morning on this stock, and this stock is closed at 68.50 something last night, and it's trading at almost $72 per share. So it's up a decent amount, 5% in pre-market. Now, this is the news that is causing this. DraftKings, as you all saw, Dish and DraftKings introduced first of its kind app integration products. And you can read the whole press release, but what it does, it is this picture. I just saved it. Where did it go? Okay, I guess I did not. But here is what it looks like. This is what this integration looks like. You will basically be able to open and use the DraftKings app while watching any live on-demand or recorded Dish TV content right from your website, right from your app. I mean, so you see this watch button, you see the record button, and you can see at the same time the place the bet button. This is a significant improvement. If you think about from the consumer standpoint, it's no longer just an app where you have to open up and then all you see is basically numbers moving as the betting patterns are taking place. I've used DraftKings many times now already since it was legalized in Michigan to place bets on various sports. But now I can be watching live games right there, maybe even record the snapshots and place bets along with it at the same time. And this is what this partnership does with Dish Networks, which buys rights to a lot of these games that come into play. Now, they can initiate the bets and they could contest entries with DraftKings directly from the TV. This will improve the engagement in my view. So something to watch. These kind of news usually result initial reaction, but then many people forget. But over time, they turn into very, very strong consumer adoption curve. I don't think there's any other app. I don't think FanDuel has this feature. I don't think there's any other sports betting app that is actually doing this right now. So something to watch. All right. That's it from me, and I will see you in the chat room shortly.